Hi, let me just double check. Okay, cool. Hi, thank you. Okay, I'll just let people click in a little bit. Um, so I had 3 questions over the weekend, and my hope is that I'm going to provide you um, some actionable advice, and I really hope that you know the way I see this is like if you're happy with how you are doing your stuff, then you can just disregard everything. But if you feel okay, you know what? I feel that I want to change my process and optimize. Take what you want from this. Um, I'm going to go through 3 questions. As always, this is something that is interactive. So I am going to talk for about 10 or 15 minutes. Feel free to interrupt. If you prefer to wait till the end, that's whatever, basically. This is something for you and for you to take what you want. And as always, like let me know if there's other stuff that you kind of want some more understanding, or maybe you want me to do another topic on. So I'm not going to waffle on any longer. I think there's a few people already here. So there are 3 questions that I'm going to try and answer today. The first question is how I think about rebalancing. The second question is an explanation of my fundamental process towards investing. And then the final question is about how I try to understand growth rates going forward. Okay. So the way I've set this up is I'm going to tackle the easiest question first, and then it's going to kind of get more complicated. So the rebalancing aspect is, I don't really rebalance. Okay. So for example, I recommend a stock, or when I buy into a stock, I always say to somebody, okay, buy the stock when I recommend it, but leave 4 or 6 weeks to kind of to get a bit more understanding about the business, because you know I or you, whatever, we don't really know that business until we've been a shareholder in it. So just think about that. And I don't believe, despite me trying to be an inflection investor, I don't believe in trying to time the market. This is something that people love to say, and depends on what kind of books you read. It's complete nonsense, in my opinion. I believe that the time in the market is really what defines your prospects at driving a return. So when I buy a stock, I recognize from the moment that I'm buying that stock, the moment I'm clicking buy on that stock, there is a 50% chance that I could be wrong. Okay. The stock can go down, can go up. I'm obviously working hard. I work really hard to try and improve the level of skill that I bring to the table. But I start with that premise that I can be wrong. So I'm trying to be humble, and I'm trying to leave a margin of error. So throughout this webinar today, I'm going to talk about PayPal, simply because it's a stock that I would like to believe that most people will be familiar with PayPal. If I said about a different stock, you might not really know it as well. Even if you're not invested in PayPal, you kind of know PayPal. So I'm trying to talk about something that is relatable as much as possible. Now, when I come to put in the work and recognizing that I want to give it time for the thesis to develop, I think to myself, okay, when I make that investment in the company, over a period of time, you will see a development. It's either that in 6 months' time, it's aligning with your original hypothesis or it's not. And what I suggest, what I like to do, is I have this 1 year hold period. After 1 year, if it has not worked out, it's okay. No regrets. I try my best and it's out. And the reason why I don't like to kind of react quicker than a year is because sometimes, the first 6 months, it takes a bit of time for things to develop. And I don't want to cut it too quickly. So a year holding period, I think, is enough. So I would dump the loser after a year. Now, after the year with the winning stock, I don't want to hang around for too long. Okay? I'll probably give it another 6 months or so. And the whole period, if it's successful, 18 months, I'm out. Now, why would I not want to hold it for longer? Is because I am looking for a change, an inflection, a re-rating of the stock. And I believe that you get the bulk of the re-rating in a short period of time when people say, actually, things are different to what we originally felt. And you get that change and you can go. And you need to be having a relatively high return over those 18 months to compensate for the fact that you're going to get things wrong. So everything that I'm talking about here is about, as much as possible, having that margin of safety all the time, all the time, all the time, all the time. And the thing is, I see from people's commentary, and when the market is moving really fast in one direction or another, people get confused. And I have been now through these cycles to recognize that it is to your detriment to look to the market for a reaction of what to do. So I'm going back to PayPal. So I recommended PayPal, and it went through its first earnings results, and the new management team came in, and the guidance isn't particularly satisfactory. And for me, I understand that's part of the process. That's why I say give it a year, and when I look, we're going to come to, later on in this part, we're going to talk about how I project the growth looking out. But you are trying to, when the stock fell, PayPal, when the results came out, I can't remember now, I think it was the Thursday. Sorry, they came out on Wednesday night, I believe, and on the Thursday, the stock was down like 10%. And so you write, shall I sell now? Like it's down like 10% and it's like a loss, and shall I dump this loser? And I'm like, this thing of looking to the share price, to what to do is not helpful, because stocks do move around, but you have to see. And I always try and go back and reiterate, this is the key message of what I'm looking for. Some businesses are high growth businesses, so you really need the high growth to be evident. You really need that in the guidance. Other businesses are not high growth businesses. What you need to recognize in those instances is that the amount of profits as a percentage of revenues remains relatively stable, because this is what really drives the multiple, is the change in expectation, in profitability. And you can track this, okay? Now, when it comes to a business like PayPal, but you can look towards other businesses as well, these kind of slower growth businesses, it's much easier for those businesses to cut back on excess costs. They have some excess teams in there they can cut away. That is much easier to do than for them to find some way of finding a new customer. So you need to kind of think about the margins that the business is capable of doing over the next 12 months. Now, again, I got like how I think about the rebalancing. So I strongly believe in trying to equally weight the portfolio. You don't need too many stocks, but in my experience, having less than 10 is recipe for disaster. And I know that Charlie Munger and other successful investors always talk about like going for the jugular, and I understand, but these individuals are the best of the best of the best. No, you nor I, unfortunately, are ever gonna be Charlie Munger, but we can have a reasonable 15% compounded annual growth rate in our portfolio if we're just sensible about it. If you look at a business, again, I'm referring to PayPal just because it's things that people know about. And if you look at a business that is, has a, let's say, hypothetically speaking, is making about 10% operating margins, and they take out some fat and then they have like a 13% operating margin, it's not a lot. You're talking about 300 basis points. It's not a massive difference, but that can be accomplished with some effort in 12 months. So when the investor comes into the stock in early 2025, they'll see a highly profitable PayPal and they'll be like, oh my gosh, this business is actually surprisingly profitable. It's not growing that much, but it's a really quote unquote high quality business. And this is where you get the bulk of the return, is when people's perception comes in and they have this vision of a high quality business. Because when the high quality business comes in, you don't need a lot of growth. Like just as a reference point, you look at something like Coca-Cola, it's not growing that much, but it's high quality. It's a blue chip. What you want to do is you want to get in when there's a lot of uncertainty. It's kind of okay, but it's boring. That's like, but there's uncertainty. It's like, oh, what's going to happen here? I'll wait 6 months. And when you can see that, okay, things are starting to stabilize. And by stable, we're going to talk about the growth rate in a minute. But essentially, what I'm trying to do is I'm trying to make you think a lot about going forward. The market, by definition, in my opinion, looks forward 6 months. So look forward to next year. Always try, like just as part of your process, always try and visualize what will next year's investor think about this. And you'd be surprised at how much the market can change in 30 days. And in a year, it's completely different, man. It's completely changed. But people will still want to back businesses that make a lot of earnings. And if you can visualize a path to increased earnings, doesn't need to be a lot. But I'm, as I explained already, if I'm trying to grow the whole portfolio by 15%, and the business is growing on the bottom line, I don't know, let's say around about 15%, provided the multiple remains relatively the same, I'm going to get a 15% return on the stock. But if hypothetically they cut out a bit of fat and you get a bit of a re-rating because the margins are expanded, just 300 basis points. So all of a sudden you're kind of getting close to 18%. And then when it comes like over the passage of time, the share price looks a bit more stable. It becomes less volatile. People believe that it's more predictable. And that's really the jazz. The jazz is to get involved in a business that people have confidence. And that path that I've described over the 12 months, when people are more confident, they're more willing to pay a higher multiple. As a counter to that, you look at something like Palente. Palente is obviously something that I've owned for a bit longer, but it's essentially the same premise here. I don't know if you remember, George. I was actually saying this to you. Like I was saying, like I believe that Palente by the end of like 2024, it's going to hit $30 a share, and it looked impossible. Like we was at $16. It looked like this is madness. But I was saying that once people it's like a pendulum. Sentiment swings like this, but You give a business time, and if they're increasing the amount of free cash flow, at some point, so that pendulum will just kind of swing, and people are like, oh my God, it's making a ton of money. No, it's not making like significantly more money. It was just making on that path, but with the passage of time, that cash became closer to you. And all of a sudden it's like, oh, actually it is gonna make that cash. It's like, and then people get really excited. And when with Palantir, what I've been saying for a long time is that once that stock is picked up by ETFs, because it's something that's going to join the S&P 500, it's kind of going to become a blue chip. People have more confidence, and that confidence leads to a higher rating on the stock. Okay, the second topic that I want to talk about is really explaining this fundamental process that is in my mind of what I'm looking for. So in the ideal scenario, I want a company that people are not particularly interested about at this particular moment for whatever reason. It helps if if the setup is nice. So by what I mean nice is that the company is under some pressure to do something. Here I'm thinking, for example, of Match Group. I'm thinking about DraftKings. When the share price has been kind of a laggard, it's been kind of not doing particularly well, there's some pressure from the management team to do something to increase the profitability of the business. And shareholders have some doubt, so they're not really rewarding the stock particularly highly. And that, I believe, is something that, people are not paying high premium. But again, when small changes in profitability, 300 basis points, for example, in the case of, you can see this is already working in DraftKings, but when the business goes from being unprofitable to profitable, that change, often cases that it goes from, let's say, negative 2% to plus like 2% or whatever, that's 400 basis points. But it's like so much more exciting because the business is growing, has cash, is self-sustainable, and all those problems that, like, for example, the balance sheet is not particularly strong. When the business becomes highly profitable, all of a sudden that the multiple that people will be willing to pay for the stock goes up. And I'm going to try and share my screen just briefly here, if I can. Hold on a second. I'm going to talk about. Okay, 1 second. I'm hoping that I'll be able to show you the. 1 second. Okay, that's not going to work. Hold on a second. Apologies for this. Okay. Okay, so if I show you this. Okay, I'm going to try this. Okay, so this is what I was writing about PayPal in the run-up to the Q4 results. So in my mind, I believe that it's really important to, whenever you invest, to try have a bit of common sense and a bit of critical thinking. So don't go for heroics. Look forward at the business. So I was kind of thinking, okay, I believe that when they come out of the Q4 results, you will have visibility in PayPal that they'll be growing at very close to 10% compounded annual growth rate. And when the results actually did come out, they said, actually, we're only going to grow at 7%. Now, as I tried to explain when I've written the report straight away on the back of the results, that 7%, they're partially lowballing that because it's not in their interest this early in February, this early of the year, for them to come out and say, oh, we're actually going to grow close to 10%. Even if they ultimately grow at 10%, or even just close 9% or something like that, it's not in their interest to come out with such a strong guidance, but you have this common sense approach on your as the results unfold each quarter. Try and just have a vision. Does this sound realistic? Yes or no? What I'm trying to look forward towards the growth of the business. Always try and think about it in this manner. It's going to be approximately the same as what they were doing in the last couple of quarters. So it's not likely to decelerate substantially, and it's not likely to accelerate substantially. So just have this kind of thought process. And now I'm going to just explain with Palantir. So on the run up here with Palantir, I'd also said, okay, I think that it's going to grow kind of close to 20%, the guidance when it comes out. And the previous 2 quarters, it was coming at around 17%. So I just thought, okay, the hurdle from 2023 is lower because in 2022, they were growing quite fast still. So the bar is lower than 2023. So it's possible for them to have just a tiny bit of an acceleration into the year ahead. And it's kind of a joke, but I kind of say this like the bananas multiple. When a stock, a tech stock, accelerates its revenue growth rates without giving up too much of its free cash flow margin, that is free cash flow divided by revenues. So if the business is able to accelerate its revenue growth rates without giving up too much of its free cash flow margins, it's a joke, but I call it like the bananas multiple, because you get such an expansion, because all of a sudden it's like, oh, they've refound their growth. No, they haven't refound their growth. It is common sense. It was coming down anyway, the hurdle. So just continue at the same normalized pace that they were doing anyway. You will get just naturally an improvement in the guidance. So you're gonna see investors, oh wow, this is so exciting, and then the share price goes up. And as the share price goes up, you get the momentum traders and the news outlets saying, oh, like they're amazing, blah blah. But your work that I'm describing now, that you put in, is on the run up to that. Because what you don't want to be doing is you don't need to, quote, too flat-footed, chasing everything that's kind of popping around and not having done the work. It's better to be extremely selective. And if I'm honest, I would say that everything that I do in investing, anyone can do it. Like anyone can. It's really, really simple. As I've described to you in like 20 minutes. It's really, really simple what I do. The only advantage that I have relative to other people is that I'm extremely stubborn and selective. That's the only advantage, because I follow a lot of companies. I'm always looking at companies all the time. And it's like a database in my mind. And if I'm looking, let's say, at 100 companies, I just have to find that 1%. I'm just looking for the 1% that is going to be, oh, this could work. That's all I'm looking for. Because what you don't want to do is, I see so many people say, oh, this stock, that stock is working, that SaaS stock is working, but they're all working off the same factor. By that, I mean, it's all working from the change in the interest rates. And that is not going to give you diversification when things hit the fan. And they will hit the fan. Rest assured, they will hit the fan at some point, because the market has been too excited. And you need to have some stocks that are not exposed to the same factors. Like, I'm telling you stocks that I own and recommend, like Uranium Energy Corp, Builders First Source. These type of businesses, they have absolutely, like Match Group that I already mentioned, this type of stuff that has nothing to do with these kind of AI plays. You need to have some diversification, because nobody wants to have a diversified portfolio when every single stock that they're buying is doing the same thing. Like, oh, Cloudflare, whatever. It's like, oh yeah, everyone's like singing and swimming. And I get it. I recognize the appeal of that, and I'm not dismissive of that, but I've been through this. And you can use my experience that it doesn't matter how much money you think you're making, it's how much you keep at the end of the year. And I'm very cognizant of that. And I always think myself, okay, when it comes down to it, and it comes to tally up the results at the end of 2024, did I deliver to my family what I set out to do? Because a lot of people will say a lot of things, and it's easy to get distracted by that. But I'm just saying, try and have some selectivity in your process. Don't go in all at once on a stock. Have it equally weighted. Try as best as you can not to get too caught up with the narrative of a stock. So when you buy, I call it like the first bullet and second bullet, try and kind of spread out your investment. So don't go in at once. And finally, this is like a piece of advice that I hope is helpful for you, is that don't put yourself in the position to buy every dip on the stock, because what happens is you put too much capital in a business, you become too emotionally attached to that, and you're looking at the share price and you need the share price to go up because it's been 2-3 months and it's just not going on your direction, and emotionally that causes you, man, too much cortisol. And it's really, really important that you have a balanced frame of mind and a balanced portfolio, to so that when things do hit the fan, you can be in a position that you're not too distressed. I've waffled quite a bit, and yeah, I hope that's been helpful. I'll open it up to some questions if anyone wants to kind of ask anything, please.
Hello, this is Vasilis.
I
Thanks a lot for answering my question. My question was the first one, actually, the easiest one. Yeah, thanks a lot for the blog, very useful. I just wanted to make sure I understood clearly. So you try to keep your positions equally weighted, but you do it by just controlling the amount you buy in. So you don't change them afterwards. The only possible action you might take later is to sell it entirely. Or do you make exceptions? For example, if a high flyer is, let's say you entered with 7% of your portfolio and now it's like 15-20%, then maybe you still consider it a buy, but not a strong buy. And you say, okay, I'm not going to sell it because it deserves to be there, but maybe I will trim it from 15 to 10% so that they just get the money for the new stock incoming.
So respectfully, no, not really. So I used to have this 7%, and I've seen that doesn't work for me personally. I've tried to have just 3%, and what I'll do nowadays is I'll put 1.5% of the portfolio. I'll wait about 4 to 6 weeks to get a bit more familiar with it, because when the share price is moving and you buy a stock and you don't really know what's happening, you haven't got a clue. But for my process, I find that when I walk away from it and I give myself time to understand the business, and you can learn the business overnight, you only know that business once you own the share price. So I put 1.5 down, I wait some time, preferably I give it at least like 6 weeks, and if possible I wait until after the earnings results come out. Then I will not trim that position until I want to cleanly get out of it. So I wait at least a year. So I try not to make exceptions, and I try not to kind of fall in love with the idea that, it needs more capital because my thesis is working out. So I'm looking for that rewriting. I saw that you posted a question about the CPI, but it's important, this part here. Did I explain this part?
Yeah. I think I get it now. Yes.
Yeah.
You're pretty like strict with your way of changing
Yeah.
things, and it's
Because
easy to follow then, right?
exactly. But also, I read a lot about, over time I've been investing and stuff like that, and I've read a lot about biases and they creep in, you know, oh my gosh, they really creep in. Like, it's like, let me describe, for example, I recommend a stock, Celestica. It's like boring business, man, really boring. But I'm like, okay, yes, it might not be the most attractive story going. I get it, you know, but sometimes don't let that creep in. Don't get caught up. And we, and you know, I'm talking about the stock, and I know it is working right now, but you know, it might not be working, but blah blah. But it is working. But don't, you know, for me personally as an investor, if I can make 5% in 6 months, I'm just okay. I'm not going to complain. So it's better to think about the fundamentals, and more specifically, it's better to think about what the free cash flow will be next year than to get caught up with anything else, including the share price, whether it's going up or down, the CPI report, or anything else. What happens today in the market means zero. What matters is what's going to happen next year. And news outlets and stuff like that love to kind of say, oh, interest rates are going up, interest rates are going down. None of that matters. That's just a distraction. And I strongly, strongly recommend you avoid all those distractions. And I'll say more. I class myself as a professional investor. And in my career, whenever I've listened to the news, I've often made a loss of capital. In my career, I have never once listened to any news outlet and made a positive return from that in news that I picked up. CPI, interest rates going up or down, it has been a complete and utter waste of my capital. As an investor, time and the increase of free cash flow are the two most important variables. You want to leverage that time to get your return. You want to get that re-rating, and that re-rating in the stock, that inflection, I call it inflection, is what's going to drive your portfolio. So when you look at the end of the year, you're not going to say, oh, the CPI in early February, people were saying the interest rates are not going to actually come down. That's not going to help. Don't worry about that. Just focus seriously about not overcommitting to any business. Like, I own Meta, don't like, oh, Meta's amazing, oh, blah, blah. Like, don't overcommit. You have a process, follow a very strict protocol. Make it as systematic as possible. Did I manage to answer that question?
Yep, thanks a lot.
Cool. Does anyone else want to ask a question? Still got a few minutes. Oh, thank you. Still got a few minutes. Maybe someone wants to ask a question about certain thing.
Okay, so then I have a follow-up question. I think also someone else asked that on Twitter, maybe not clearly. So when you define your losers, let's say you come back after a year and you have, let's say, 3-4 stocks that have already been there for a while. Then for me, a loser, until now at least, it was not the one where I'm negative on the P&L currently, but the one that I maybe my thesis did not work out, but also it will not work out in the future. But it could be that one is still losing, but I still believe that it has a reason to inflect, as you say, in the next months, and then I will still stick to it and not kill it just because it's negative after a year.
Can I give you a practical example of something that I own? I own this Albemarle, which is a lithium company. It's been a complete waste of my capital. It's drained me psychologically. It's a loss. I have it in the portfolio. I openly talk about that I made this mistake, but I keep it in the portfolio for now until the earnings results come out. Now, if the earnings result come out and it's really bad, I'll get rid of it. And if it comes out and it's amazing, it needs to be absolutely amazing for me to keep it, because I will just clean that out. So what I'm looking for is to know that it's okay to take a step back. Maybe I'm right that lithium is going to be really important to this whole energy transformation. Maybe I'm right on that, but it's okay to take a break, step back, give it 3 months, give it 4 months, maybe 6 months, come up with a fresh mind, do the work again. And you will find that just by stepping away from the entrenchment that you have on a stock, it's really liberating. Some traders are more aggressive with that. They'll often talk about the fact that they come in at the end of the week, wash out all the positions on Friday night, and come in with a fresh mindset on Monday. I'm not sure that's particularly constructive either. There are many different ways to skin a cat. So I could just tell you, when you have a loss, and don't think that, oh, it's down, but the fishes can still work out. If you held that position for a year, the market is telling you, I don't agree with you. You are wrong, and that's okay. Work from the process that you're going to be wrong 50% of the time. Work from that, and then use that as your base.
Michael.
Yeah, hiya.
Tom.
Hello.
T. Moss. Here's my question. Your methodology is almost, I would say, 100% fundamental. You agree with that?
Yeah, of course.
All right. So do you ever look at price action at all for entry and exit points or technical indicators?
I do not. Okay, honestly, I know people do. And as I said, there's many different ways to skin a cat, and that's absolutely fine. I'll give you a very concrete example that happened about 2 weeks ago. Celestica, I was recommending a stock. I think it was, I could be wrong on the exact number, but I think it was around $33 a share when it went into the earnings. It kind of came down, I think, to about 31. And last I checked was around 35 already. So it came out, the results. And if I was just taking a look at the price action, it came down. And like 24 hours later, it was already coming up. And now it's kind of like just taking off. A person looking at the technicals would have been stopped out of that position. And I could tell you the same about PayPal. So PayPal, the results came out, it was down 11%. And as of yesterday, I think it had recovered a lot of that. And so compared to the just on the eve of the results to yesterday night, it was only down 5%. So it already recovered in 2 trading sessions, the bulk of it. So I do not.
So you don't use any stop loss orders?
No. I strongly believe in that whenever I use a stop loss, I have come out of a loss. I have, and there are some stocks that are so freaking volatile. Like I own this Hims and Hers. That thing, man. Oh, even maybe you know this Giga Cloud technology. Flipping heck, man. That Giga Cloud technology can go up 10%, down 20% in one trading session. Like anyone with a stop loss, you'd have been stopped out like all the way. And I think I'm up about 70 or 80% on that stock since December. But along the way, I am positive so many people got stopped out, including my service, that they know this stock. Because these stop losses, man, like they just make the broker rich. Focus on the process.
Thank you.
Okay.
All right. One more question.
Mm-hmm.
This is one of your recommendations on UEC, uranium. Yeah. Do you look at the price of uranium at all? Or?
Yeah, I look at the price of uranium, provided that it stays above $60, $65 a pound. I know that this is a viable business. Approximately it's 100 and something, 100 and change. So as long as it stays around that, but I compare and contrast with its peer like Cameco just to see whether everything is still tallying up. So I do look at the price of uranium, yes.
Thank you.
Okay, thank you, everyone. So hope to see you next time. Thank you so much for the turnout. See you soon. Bye-bye.
Thank you very much.
Thank you.
Thank you, Michael.
Thank you.